Let's be real for a second. The stock market is on edge. Prices are climbing, investors are getting greedy, and everywhere you look, people are throwing money into the market like it's a game they can't lose. But here's the uncomfortable truth. Markets don't rise forever. Crashes are inevitable. And when they come, they don't just shake the economy, they wipe out years of gains in a matter of days. Most people panic. They sell at a loss, freeze in fear, or worse, they give up investing entirely. But the top 1%? They play by a different set of rules. In this video, I'm going to walk you through exactly what happens before, during, and after a crash, and more importantly, how smart investors use each phase to build wealth. You'll learn the warning signs, how to protect your portfolio, and how to turn market fear into opportunity. Whether you're just starting out or have years of investing behind you, what you do before the crash might be the most important financial decision you'll ever make. So grab a pen, because this isn't just another crash prediction. This is a plan to profit from it. How often do market crashes really happen? Let's get one thing clear. Not every time the market drops is a huge disaster. In fact, the stock market has a few different types of downturns, and not all of them are as bad as they sound. Some are small, some are bigger, and a few can be pretty intense. Let's break them down so you know what to expect. First, let's talk about a market correction. This is the most common type of drop. A correction happens when the market falls by 10% or more from its recent high. It's like the market is just taking a little break, adjusting itself. It happens about once a year, on average. But don't worry, these usually don't last long. They're a natural part of the cycle and are something investors see often. Next, we have the bear market. Now, this one's a bit more serious. A bear market happens when the market drops by 20% or more. Bear markets usually show up every 4 years, on average, and they can last for about 9 to 10 months. It's not fun, but bear markets aren't the end of the world. They happen because the market is adjusting, and they're usually followed by periods of growth. So, if you stay calm and stick to your strategy, you can ride it out. Now, the scary one, the market collapse. This is the big one, where the market falls by 30% or more in a very short time. These crashes don't happen often, but when they do, they can really hit hard. A market collapse is usually triggered by big events like global instability, economic crises, or even major political events. It's rare, but it's also why you hear people talk about market crashes with fear. So, what's the takeaway from all this? Market downturns are part of the cycle. They happen, and if you're going to be investing in the stock market, you'll see them. It might sound scary, but with the right approach, you can handle them. The key is being prepared. That way, when the market goes through tough times, you don't panic. You stay calm and stick to your plan. Because, remember, after every bear market or correction, the market usually bounces back. And when it does, that's when you can benefit if you've kept your cool. The 3 phases of a market crash and what to do in each. Let's break down the 3 phases of a market crash and how to handle each one. Understanding these phases can make a huge difference in how you navigate a downer. Phase 1, the euphoria phase. The market is on fire. Stocks are skyrocketing, and everyone's riding high, feeling like financial geniuses. It's easy to get caught up in the excitement, but here's the thing. It's also the calm before the storm. The market is getting overinflated, and risky assets are being bought without much thought. This is the time to get cautious. What should you do in phase 1? First off, recognize the risk. Just because everyone else is making money doesn't mean it's the right move for you. Watch out for signs of overconfidence, like wild speculation in trendy assets. Think NFTs or meme stocks. These can look tempting, but they're often bubbles waiting to burst. Next, limit high-risk investments. Now's not the time to chase after the hottest trend. Focus on investments that have proven their stability over time. This way, you'll be ready when the market corrects itself. Cut back on borrowing. If you've been using leverage, basically borrowing money to invest, now's the time to stop. Leverage increases your risk, and in a market like this, it can quickly magnify your losses. Save more. Start building your cash reserves. The more cash you have, the more opportunities you can seize when the market dips. You'll be in a strong position when prices fall and others are panicking. And finally, diversify your investments. Spread your money across different sectors. That way, you won't be overly exposed to any one asset if things start to go south. Remember, this phase is all about preparing. When the market feels unstoppable, it's actually the best time to slow down and think about what's coming next. Phase 2, the reckoning. The market has crashed. Fear and panic take over. Everyone's selling, and prices are falling fast. It's a stressful time, but if you've prepared, this is where you need to act strategically. The key is to keep calm and stick to your plan. What should you do in Phase 2? Don't sell in a panic. The fear is real, but here's the thing. You only lose money when you sell. If you believe in the companies you've invested in, it's time to hold tight. And if you have the cash, consider buying more at these lower prices. You're not losing until you sell. Stick to dollar cost averaging. This means investing a set amount regularly, no matter what the market's doing. Even as prices fall, you keep buying, which helps lower your average cost over time. It's a proven strategy for weathering the storm. Focus on your long-term goals. Now is the time to remember why you invested in the first place. Don't let the short-term panic distract you from your big-picture strategy. Stick to the plan that you know works. Look for opportunities. While the market's down, certain stocks or assets might be undervalued. This could be your chance to buy low while others are too afraid to act. Sometimes, fear creates the best opportunities. Maintain cash reserves. Having extra cash in the bank is crucial during market crashes. It gives you the flexibility to buy when others are selling, and it provides peace of mind knowing you can ride out the storm without worry. Phase 3, the Phoenix phase. The market is starting to recover. Slowly but surely, prices begin to rise. Fear starts to fade, and confidence returns. It's not an immediate bounce back, but you can see the market moving in the right direction. What should you do in Phase 3? Be patient. Recovery takes time. The market might still feel a bit shaky, and things may not fully normalize for months or even years. But this is when sticking to your long-term plan is crucial. Resist the urge to make drastic changes just because things feel uncertain. Rebalance your portfolio. After a market crash, your portfolio might look a little different. Now's the time to reassess and make sure your investments still match your risk tolerance and long-term goals. A few adjustments might be necessary to keep you on track. Stay diversified. As the market recovers, don't put all your money in one place. The key to protecting yourself from future volatility is diversification. Keep spreading your investments across different sectors so you're covered, no matter what. Invest for long-term growth. Focus on sectors and industries that have the potential to thrive in the future. As the recovery gains momentum, look for innovative areas with more room to grow. These investments can help you capitalize on the long-term upswing. Seize new opportunities. As recovery picks up speed, new growth areas will start to emerge. This is your chance to tap into fresh opportunities that align with your investment strategy. By getting in early, you can maximize your returns as the market continues to improve. Market crashes are part of the cycle. If you stay calm, stick to your strategy, and make thoughtful decisions, you can not only survive, but come out stronger on the other side. Want a safe, steady way to grow your money? Building a portfolio that can weather a market crash is important. But while you're focusing on that, don't forget about one more way to grow your money: high-yield cash accounts. Here's how they work. Imagine you start with $5,000 and add $250 every month. You put this into a high-yield cash account that offers a 5.1% interest rate, compounded daily. In just 5 years, you'll have earned $3,493 in interest. And that's without touching the stock market. Why is this a smart move? First, it's safe. Your money is protected, so there's no worrying about it disappearing during a market dip. Plus, you don't have to worry about volatility. This is growth without the stress. Second, it's predictable. Unlike the stock market, where prices go up and down, the interest rate on a high-yield account is steady. You know exactly how much you'll earn. No surprises. And third, it's consistent. While the stock market might go through big swings, a high-yield account grows steadily. Over time, that's a simple way to build wealth without the risk. So, if you're looking for a safe, steady way to grow your savings without worrying about market crashes, a high-yield cash account could be the right choice for you. It's perfect for building a strong foundation for your financial future. And remember, the more you put in and the more you add over time, the more your money works for you. It's not about huge gains overnight. It's about steady growth, which can make a big difference in the long run. Want a safe, steady way to grow your money? Building a portfolio that can weather a market crash is important. But while you're focusing on that, don't forget about one more way to grow your money: high-yield cash accounts. Here's how they work. Imagine you start with $5,000 and add $250 every month. You put this into a high-yield cash account that offers a 5.1% interest rate, compounded daily. In just 5 years, you'll have earned $3,493 in interest. And that's without touching the stock market. So, if you're looking for a safe, steady way to grow your savings without worrying about market crashes, a high-yield cash account could be the right choice for you. It's perfect for building a strong foundation for your financial future. And remember, the more you put in and the more you add over time, the more your money works for you. It's not about huge gains overnight. It's about steady growth, which can make a big difference in the long run. Crashes are scary, but they're also full of opportunity if you know what to do. When markets dip, it's easy to panic. But here's the thing. While crashes might feel like a setback, they also offer a chance to grow your wealth if you handle them the right way. So, how do you make sure you're ready? 1. Prepare during the euphoria. When the market's up and everyone's talking about the next big thing, that's when you get cautious. Don't chase the hype. Protect yourself for when things turn around. 2. Stay strong during the reckoning. When panic sets in and the market starts to drop, don't sell in fear. Remember, the real opportunity is when prices are low. Stick to your strategy, hold your nerve, and look for chances to buy good assets at a discount. 3. Invest consistently to rise with the phoenix. After the crash, the market will rise again. The smart money invests during the downturn and sees big rewards during the recovery. If you stay consistent, you'll be ahead when the market rebounds. If you're ready to learn how to start investing, check out the next video linked on screen. Don't forget to subscribe for more tips to grow your wealth. Let's build that financial future, one smart move at a time.